Hey everyone, it's Hamish here, and in today's video we're going to be having a look at management and how you can assess management in your investment analysis. Assessing management is vital. It's a key component. If you follow me or Warren Buffett or any of these other great value investors, then you would know that they focus on these four key areas: your understanding of the business, the economic moat or competitive advantage that a company has, the price that you're paying for the business, and of course, management. And we're going to talk about why we need to assess management, why it's important that we look at management. We're going to talk about what are the different things that you need to be looking out for when it comes to management. And then I'm going to talk about some specific things that you can look for so that you can start your analysis and start to determine whether or not a management is a good fit for the company and is going to be one that is representing you in the best way possible in order to maximize your profits. If you want to see more videos breaking down specific components of stock analysis, then make sure you leave a like and let me know that you want that down in the comment section below so that I can make more of these videos in the future. But for now, guys, let's jump into it. So why does management matter? Why does it matter who is making decisions at the top of the business? Why can't we just invest in a business that has really great products that people like a lot? Why is that not just enough? And really, I can boil it down into one sentence and then I'll go into it a little bit further in depth. So the main reason is because the decisions that management make directly impact how much cash a business produces over the long term. So management, they are the people at the top of the business who are making decisions. They're deciding to make that acquisition. They're deciding how to market that product or which products should they release. They're deciding to buy back stock in order to increase shareholder value or pay a dividend. Management is the people that are making all of these decisions. And over the long term, all of those little decisions impact the business and how profitable and how successful the business is. And ultimately, that is what we want. We want to invest in businesses that are going to be as successful as they possibly can. And that means that they're going to be able to return as much cash to us over the long term as possible. And management's decisions directly impact this. While it's true that if you have a great business that's fairly simple and that has great products that consumers love and consistently come back to buy, then you could have two businesses that are the same business but have different managements, and they will both be successful because the products that they're selling are successful. They solve a key problem in the lives of people. But if you track those two businesses, which are the same business but different managements making different decisions, then over 10, 20 or 30 years, over the very long term, the very little poor decisions that one makes and that the other doesn't make will add up to being a huge difference in the amount of cash that you get back. And that means that there's a huge difference in the amount of money you should be willing to pay for a stock that is a company that has a good management team versus one that is poor. So what are we looking for in a management? And essentially, I like to look at management across two different lenses. So there's two key things that we're looking for, and then we'll break those down into what we're specifically looking for in each of those. Those two key things are integrity and skill. So we'll start with integrity. Integrity just basically means that the management is going to be honest and that they have strong principles, strong moral principles. And the reason that this is important is because when you're buying a stock, you're getting part ownership in a business. And what you're doing is you're buying into a business where you don't make managerial decisions. You just buy the stock and you put the management in charge of decisions. You don't specifically choose the management, but that's essentially what you're doing when you're buying it. You're saying this management team can make investment and debt and all of these other decisions on behalf of my business. So we want to know that they're going to tell us when there is any problems straight away. We don't want a management that is going to be hiding bad problems from its owners for many years until it's too late and then it destroys the company. We want to know about these problems up front because then we can assess how much damage that's going to do to the company, we can assess what management is saying they're going to do to overcome these challenges, and as a result, we can make investment decisions. We can decide whether or not we still want this company with those problems. And we can work out, okay, if this problem is just going to span for a year, then maybe it's the opportunity we need in order to acquire more shares. But if it's a problem that's going to last for many years, maybe 10 or more years, and is going to massively impact how much cash we can get back from it, then maybe that's a business that we no longer want to hold. But in order to make that decision, we need management to tell us about the problem. And unfortunately, in many businesses, management just does not reveal these problems until it's too late. And at that point, it's really hard to make those decisions and get out before the stock crumbles, or to make an actual rational decision about whether or not you want to be holding the stock anymore. The second way that we assess management is under their skill. So it's great to have a management team that's honest to us and telling us exactly what's happening, but they also need to be good at their job. They need to be making the best decisions possible at all times in order to maximize the cash we can get back over the long term. Any great business that has had any long-term success has had a great management making key decisions that has kept that business moving along at a high rate. And we need to assess that. And we assess their skill in essentially two key areas. The first is capital allocation, and the second is debt management. Capital allocation means the decisions of where to put money in order to grow it into the max amount of more money that they can. So management can always invest their money in a wide array of things. They could buy more inventory. They could expand their production facilities. They could try and research and develop a new product. They could buy back their own stock. And all of these decisions are investments. They're putting out $1 and hoping to get back more than $1. And if we can assess their skill in terms of their capital allocation, if they're very good at sending out money and bringing back a lot more money, then over the long term, they're going to be able to dramatically increase the cash flows that we're going to receive. And the second way that we can assess management skill is through their debt management. Now, we should think of debt as pouring gasoline on a fire. It can be a really cheap and easy way to grow the fire, but if it's mismanaged, if you pour too much gasoline on the fire and it gets out of control, it can bring the whole thing down to the ground. Debt is simply more money to invest. It's just getting more money to make investments within the business. So often, if there is investments available, but a company doesn't have enough money within it in order to make those investments, then taking on a little bit of debt can be safely done in order to increase the growth rate of that business. However, you can also have a management that is using too much debt in order to fuel their operations. And that is definitely a bad thing, and it can end horribly. So we always want to invest in businesses that are not taking on too much debt that we have to worry about it, and that it's going to keep us up at night worrying whether or not they're pouring too much gasoline on the fire. So to finish off this video, let's talk about what you should specifically be looking for in order to assess these areas. So there's two main areas, and that's integrity and skill. And then within skill, there's basically capital allocation, their investments, and their debt. How much sort of debt are they using in order to fuel that investment? So if we start by looking at integrity, there's a few main things that I would like to look at. Now, these are just the beginner sort of steps that you would take. And this, not beginner, sort of the foundational steps that you would take, the core things that you would look at. And then you would look beyond this at many other little things in order to assess them. But if you're just starting out, then you definitely want to start by looking in these areas. The first thing I would do is I would read all of the letters to the shareholders for the past 10 years or more. Now, these are the letters that the CEO writes to shareholders every year in their annual report. And you can read through these and find out lots of cool little things about the business. You can find out what the CEO thinks is important at the time, and you can find out when he talks about challenges and problems within the business. So you can see maybe 5 years ago, the CEO mentioned some problems. Then you can read through the letters and see if he talks about solving those problems. And a CEO with integrity, a management team with integrity, will be dealing with these problems and sharing their solutions as it gets solved with shareholders. You might have a CEO that says, we took on too much debt here and we went above our limit, our sort of safety limit, and we're not feeling too comfortable. So we're working with some people in order to bring this down over time. And then maybe in the next couple shareholder letters, they say, yep, we got our debt down, but we're just to be safe, we're going to bring it down a little bit further and we're going to keep working to keep it at very low levels. And if that actually happens, then you've got a CEO who's telling you about a problem that they really didn't need to tell you about, and then they're fixing that problem. On the other hand, you often have these CEOs which will say 5 years ago, they'll say, oh, we have big plans, we're going to be growing in this space, we're going to have 10% growth in sales and all these things. And 5 years later, they just completely don't mention it at all. They don't mention it as if like they never made that target. They don't mention that they missed their targets, and that's really, really scary to see, because it means that management is making promises and then just ignoring them as if they never made them, and it makes you wonder about what other things they're not telling you about. So that's the first area you can look at, and you can also get a better grasp of the CEO's honesty and transparency around these problems in their conference calls. So every quarter or every year, most companies have a conference call where the CEO talks to analysts. And these are really cool because the analysts are often asking painful questions. They're often poking at where it hurts near the CEO. Why is there increased labor costs? Why is this happening? Why aren't you doing this? And it causes the CEO to respond to the problems that are happening within the business. And this is where you will see whether or not a CEO blabs on about nothing and never answers the question, or whether he's completely honest and just answers the question straight up and then follows up in later sort of conference calls and explains how they solved those problems. So those are the two areas you can look at in order to assess the integrity of a management team. And then we need to assess skill. So starting with capital allocation, the main way that you want to assess capital allocation is the return that management is getting on their investments. So there's a certain amount of money that a company is investing each year, and then there's a certain amount of profit that is generated from those investments. So you want to compare those two, and you want to see that they're getting a return of at least 10% or more on their investments, and you want to see that it's growing over time. You want to see that they're getting more effective at investing within the business over time. And the last area is debt management. And here we look at a couple of key ratios, but essentially we're looking for debt to be very low relative to the equity and the cash and all of the assets that a business has within their business, so that they have enough of those assets to pay off their debt if they need to. So the first one we can look at is the current ratio, and this takes all of the current assets, all of the assets that are likely going to be converted into cash within the next 12 months, so they can be used to pay debts. And we also compare that to the current liabilities, which is all of the debt that is due in the next 12 months. So we like to see that there is 2 times as much assets as debt in the short term in the next 12 months, so that they can easily cover what is owed in the next 12 months. And then the other ratio we can look at is the debt to equity ratio, and this compares the total debt that a company has to the equity that a company has. And we like to see this at 0.5 or below, which means that a company has twice as much equity as debt within the business. And again, it just means that they're not overfueling their company with debt, and we don't have to worry about that debt destroying the company for shareholders. So I hope this video was helpful for you to understand sort of why we need to assess management, what are the reasons that we need to look at management, and why we can't just look at what the business is selling and how the consumers like what the business is selling. And then what areas we need to look at. What are the key areas of focus? We need to look at their integrity. We need to look at how skillful they are and how you can look into those areas and sort of begin the foundations of your analysis in those areas. So if it did prove helpful, then make sure you leave a like and let me know your thoughts on this video down in the comment section below. But I hope you guys had a great day, and I'll see you in the next one.